JP Morgan says $81 average for 2026. 74 million ounces moved in 60 days, crashed 33% in one session, 121.67, one day, then 33% gone. That number, 121.67 per ounce, is not a forecast. It is not a projection from an analyst sitting in a glass tower somewhere. That number actually happened. On January 29, 2026, silver printed an all-time nominal high of 121.67, a price no human being alive had ever seen silver trade at in the entire recorded history of the metal. And within the same trading window, before most people watching the charts even had time to process what they were witnessing, it collapsed. Not a dip, not a pullback. Silver fell approximately 33% from that high to around $81 per ounce by January 30th, marking the single largest intraday and overnight price collapse in the history of precious metals. The headlines called it a crash. The financial media called it a correction. But the data underneath that move tells a completely different story. And that story is what we are here to talk about today. Welcome back. I'm OG John AG. And if you're hearing my voice right now, it means this channel is still standing. For those of you who don't know the backstory, YouTube pulled the plug on my original channel. No warning, no explanation that made any sense. Just gone. Years of content, hundreds of thousands of views, a community we built from scratch, wiped clean overnight. And why? Because the analysis was a little too real. The data was a little too uncomfortable for the people who'd rather you stay asleep. So we came back. OG John AG 2.0, the backup channel that was never supposed to be the main stage. But here we are. And honestly, I don't know how long this one lasts either. I'm hearing things. There are flags on this channel, reviews happening in the background. The kind of quiet activity that usually ends one way. You've seen it before. One day the channel is there, next day it's a dead link and a memory. So let me be straight with you. If one day you come looking for OG John AG 2.0 and it's gone, don't panic. I will come back under a different name, a different handle, whatever it takes. The information doesn't stop because a platform decides it's inconvenient. Keep your eyes open. If this channel disappears, search for me. I'll make sure the real ones can find me again. But right now, we're still here. And as long as we are, the numbers do the talking and I do the translating. If you're new and this is the kind of analysis that's not showing up on your regular financial newsfeed, subscribe, not for me, for you. Because the day this channel goes dark, you're going to want to be in the loop for what comes next. Now, let's get into it. Right now, as of March 9th, 2026, silver is trading at approximately $84.37 per ounce on the spot market. For context, this metal started the year at roughly $70 on January 1st. Even after that catastrophic crash from the all-time high, even after the volatility that shook out nearly every retail position built on leverage, silver is still sitting 20.5% above where it began 2026. Gold, meanwhile, is trading near $5,089 per ounce, down 1.35% on the day, but operating at levels that would have sounded like science fiction just 18 months ago. The DXY, the US dollar index, the basket of currencies against which the dollar measures itself, is sitting at approximately 98.81, below the critical psychological level of 100. The dollar is weakening. The metals are watching. But here is the question none of the financial networks are pausing to ask. If silver crashed 33% in a single session, why, 2 weeks later and then 2 months later, is it still trading 20% above where the year began? Why hasn't it corrected back to the 60s or 50s the way a speculative bubble typically deflates? Hold that question, because the answer lives in a data set that most people scrolling silver content on YouTube have never heard mentioned. Let's go back to the beginning of this year with clear eyes. Silver opened 2026 somewhere around $70 per ounce. That alone was extraordinary, and in April of 2025, the gold-to-silver ratio stood at 105.1. That means it took 105 ounces of silver to buy a single ounce of gold. To put that in historical perspective, since 1985, the average ratio has been approximately 70. A ratio of 105 is not just elevated. It is a distortion. It is the market screaming that something is mispriced. And then, over the following 9 months, the compression began. Silver started moving. Not the way speculative assets move. Not in random bursts tied to sentiment, but in a sustained structural climb that culminated in the most explosive January any precious metal has ever produced. Silver surged 65% in January 2026 alone. Not 6.5%, not 16.5%, 65% in 31 days. That is not a speculative frenzy. That is a structural reset happening in real time. By January 26, silver had already broken records. By January 29th, it printed $121.67. And in that moment, the gold-to-silver ratio briefly fell below 50, a level not seen since 2012, a level that, according to Forbes, has occurred on fewer than 6% of all trading days since 1985. Silver, from April 2025 to its January 2026 peak, had gained 147%, while gold, which everyone was watching, gold which crossed $5,000 and was making headline after headline, gold advanced 67% in that same period. Silver outran gold by more than double. That is not noise. That is signal. Now here is where we get into the territory that made me open this video the way I did. Because while the price was doing what it was doing on paper, spiking, crashing, consolidating, something entirely separate was happening at the physical delivery level. And these two tracks, paper price and physical reality, have been moving in increasingly opposite directions for months. The question of which one is telling the truth is the spine of everything you're about to hear. In a moment, I'm going to show you a set of COMEX delivery numbers that, when you see them laid out, will completely change how you interpret the silver price action of January and February. But before we get there, we need to set the stage with the structural backdrop, because the physical story does not make sense without it. The Silver Institute, which is the primary global research authority on this metal, confirmed in its February 10, 2026 annual outlook, relying on analysis from Metals Focus, the leading London-based precious metals consultancy, that the silver market is heading for its sixth consecutive year of structural deficit in 2026. Let that land for a moment. Not 1 year of deficit, not 2. 6 consecutive years. Every single year since 2021, the world has consumed more silver than it has produced. The cumulative deficit across those 5 years through 2025 is estimated at approximately 820 million ounces. That is not a rounding error. That is a mountain of metal that was supposed to exist but does not. For 2026 specifically, total global silver supply is forecast to reach 1.05 billion ounces, a decade-high figure, up 1.5% from 2025. Mine production is expected to edge up 1% to 820 million ounces, supported by projects in Mexico, Canada, Morocco, and China. Silver recycling is projected to rise 7%, surpassing 200 million ounces for the first time since 2012, as consumers take advantage of elevated prices to sell back scrap, particularly silverware. On paper, this sounds like meaningful supply growth, and it is. But here's the problem. Total demand, even after accounting for declines in jewelry and some industrial segments, continues to outpace total supply. The Silver Institute's forecast calls for a 67 million ounce deficit in 2026. That is the shortfall, the gap, between everything the world will produce this year and everything it will consume. 67 million ounces, and the only way to fill that gap is to pull metal from above-ground inventories. Which brings us directly to COMEX. Pull up CME open interest data right now while this video is running. Look at what happened during January and February 2026 delivery months, because what you're going to see should not be possible at this stage of the cycle, and yet here it is, sitting in publicly available exchange data for anyone willing to look. In January 2026, COMEX silver deliveries reached 49.2 million ounces. That is 10 times the delivery volume recorded in January 2024, not 10% higher, 10 times. Then February 2026 delivered 5,036 contracts representing 25.18 million ounces, which is 5 to 8 times the historical norms for what is typically the lightest delivery month of the year. Add those 2 months together. 74.38 million ounces of physical silver, demanded from and delivered through COMEX warehouses in just 60 days. 60 days. Here is why that number is staggering. As of the CME's official stock report dated March 6, 2026, total COMEX registered silver inventory, the silver that is actually vaulted, certified, and available for physical delivery, stands at 81,306 ounces, 81.2 million ounces. That is what is left. In 60 days, COMEX delivered metal equivalent to 86.4% of its current entire registered inventory. 86.4% of what currently sits in those vaults walked out the door between January 1st and the end of February. And that's not counting the March delivery cycle, which opened with 10,526 contracts standing for physical delivery, representing 52.63 million ounces, against a registered inventory that, at the time of first notice day on February 27th, stood at 86.13 million ounces. Paper says the price crashed. Physical says buyers are pulling metal off exchanges at a rate with no modern precedent. Both of those things cannot be telling the same story at the same time. Let me give you the full picture on the demand side, because the deficit is not purely an investment story, it is an industrial one. Industrial fabrication of silver is forecast to decline by 2% in 2026 to around 650 million ounces, a 4-year low. The headline reason is the photovoltaic sector. Solar panel manufacturers have been aggressively thrifting, reducing the amount of silver used per panel, and in some cases substituting away from silver entirely. Global solar installations continue to grow, but silver's share of that demand is being engineered down. That is real. That is a headwind, and it matters for any honest analysis. However, and this is critical, the structural growth vectors elsewhere in industrial demand are not slowing down. Data center expansion, artificial intelligence infrastructure build-out, and automotive electronics continue to grow as consumers of silver across a wide range of applications. Silver is in every circuit board, every relay switch, every contact in the electrical architecture of the modern economy. AI infrastructure alone is creating demand for silver in cooling systems, conductors, and components at a pace the market has not yet fully priced. These are not speculative applications. They are physical, industrial, irreversible consumptions of metal. The physical investment side tells a different story from industrial demand entirely. Physical investment in silver is forecast to surge by 20% in 2026 to a 3-year high of 227 million ounces. After 3 consecutive years of decline, Western retail investment is expected to rebound sharply, driven by silver's exceptional price performance and persistent macroeconomic uncertainty. Global ETP holdings currently stand at an estimated 1.31 billion ounces. Coin and bar demand has strengthened in recent months. As of February 9th, silver had already risen 11% year-to-date, even after the crash from its all-time high. The Silver Institute's language on this is precise. Physical liquidity in the London silver market may remain relatively tight throughout 2026, and the market will continue to rely on drawdowns from above-ground inventories to close the demand gap. Where did 820 million ounces go? That is the question that sits at the center of all of this. The cumulative deficit since 2021 is approximately 820 million ounces. COMEX registered inventory declined from 240 million ounces in April 2020 to 81.2 million ounces as of March 6, 2026, a decline of 64.1%. Shanghai Gold Exchange silver inventory hit 10.24 million ounces in early February 2026, its lowest level since 2015. Combined, the COMEX and Shanghai drawdowns account for roughly 161 million ounces over 6 years. That represents approximately 19.6% of the 820 million ounce cumulative deficit. The remaining 659 million ounces, the 80.4% that is not visible in exchange inventory drawdowns, has been absorbed by irreversible industrial consumption. Solar panels, electronics, EVs, medical devices. That metal is gone. It cannot return to market without prices significantly higher than current levels, because the economics of industrial silver recovery are simply not viable below a threshold that the market has not yet cleared. Now I want to step back from the bulls for a moment and give you the other side honestly, because there are serious, legitimate arguments for why silver's current price action could be the beginning of an extended consolidation, or worse, a deeper correction. The bearish case starts with industrial demand. A 2% decline in silver industrial fabrication to 650 million ounces is not a catastrophe, but it is a trend line pointing in a direction that could accelerate. If photovoltaic thrifting continues at its current pace, and if substitution technologies mature faster than expected, silver loses its most powerful structural demand driver. The solar growth story was supposed to be the multi-decade anchor for silver demand. If solar manufacturers effectively engineer silver out of the panel, that changes the calculus meaningfully. Second, jewelry and silverware demand is falling hard. Jewelry is down more than 9% to 178 million ounces, its lowest level since 2020. Silverware is contracting by approximately 17%. Both of these are price sensitivity reactions. When the metal is expensive, consumers buy less of the finished product. If prices stay elevated, discretionary demand does not recover. India, historically one of the largest silver jewelry and silverware markets in the world, is leading these declines. A weaker rupee against the US dollar makes imported silver more expensive in India, compounding the price sensitivity. Third, the Reuters consensus poll, published in early February 2026, projects an average silver price of just $79.50 per ounce for the full year of 2026. That is a consensus of professional analysts. It implies that despite everything, Despite the record all-time high, despite the structural deficit, despite the COMEX delivery volumes, the professional community as a whole expects silver to spend a significant portion of 2026 below where it is trading right now. JP Morgan's base case stands at $81 per ounce annual average for 2026, with quarterly projections ranging from $84 in Q1 to $85 in Q4. These are not doom scenarios. They are sober assessments from institutions with enormous analytical resources saying, the bull case is real, but do not assume the price runs in a straight line from here. And fourth, and this is the one that deserves the most scrutiny, the January 29th crash itself. Silver went from $121.67 to approximately $81 in less than 24 hours, a collapse of roughly 33%. That kind of move does not happen in a healthy, well-supplied market. It suggests that a significant portion of the move to $121 was leveraged, paper-driven speculation that unwound violently when the margining cascades began. If the speculative overlay can add and subtract 40 points from the price in a single session, then the structural deficit narrative, as real and documented as it is, does not protect you from short-term volatility that is violent enough to liquidate positions. That is the honest bearish case. Hold it in one hand. Everything that came before holds in the other. Now let's talk about where the pieces are pointing. Gold is currently sitting at approximately $5,089 per ounce, down 1.35% on March 9th from the prior session. But let's be precise about the gold context. The gold price on March 8 was $5,152. The April 2026 futures contract is sitting at $5,096.7. Gold has now risen 76.44% over the past 12 months per trading economics data. Gold crossed $5,000 for the first time in history, crossed $5,100, and is now in a zone of consolidation that has some analysts targeting $5,500 in the next month or two. A projection from Thomas Windmill, portfolio manager at Midas Funds, has cited in late February 2026. The gold-to-silver ratio is currently sitting at approximately 60. On March 2, 2026, with gold at $5,287.40 and silver at $93.25, the ratio printed at exactly 57.77, the tightest ratio the market had seen since those brief January 2026 days when it fell below 50 for the first time since 2012. The ratio compressing from 105 in April 2025 to where it is now. That compression alone represents the most dramatic repricing of silver relative to gold in modern market history. Silver gained 147%. Gold gained 67%. The ratio told you which horse to be on. Bank of America's metals research head, Michael Widmer, has not been subtle about what he sees as the potential forward scenario. His published range for 2026 sits between $135 and $309 per ounce for silver, not as a base case, but as ratio compression scenarios grounded in historical precedent. The $135 scenario maps to the 2011 gold-to-silver ratio low of 32.1. The $309 scenario maps to the 1980 Hunt Brothers ratio of 14:1. These are not fabricated numbers. They are what the price of silver would need to be at today's gold price if the ratio compressed to those historically observed levels. Widmer's framing is important. He presents these as ratio compression outcomes, not directional calls. But the fact that a major institutional research head is publishing those figures at all tells you something about how seriously this market is being taken at the institutional level. Citigroup, for its part, had forecast silver reaching $100 per ounce by this month, March 2026, with further upside to $110 by the end of Q2. Given that silver touched $121 in January and has since pulled back to $84, Citigroup's March target has not held, but their Q2 $110 target remains an open question. The DXY, the US dollar index, deserves its own moment of attention here because it is one of the most underreported variables in the precious metals conversation. As of March 9, 2026, the DXY sits at approximately 98.81. It is below 100. The March 6 close was 98.99. March 5 was 99.32. March 4 was 98.77. The dollar is not collapsing, but it is not strong. The DXY fell sharply on the back of a weaker than expected U.S. February payroll report and the narrative building around Federal Reserve policy uncertainty, specifically concerns about the Fed's operational independence from political pressure, has created a macro environment where the dollar's safe haven premium is being actively challenged. A structurally weaker dollar is historically one of the most consistent tailwinds for metals prices across the board. There are geopolitical inputs layered on top of this macro backdrop that cannot be dismissed. The ongoing hostilities between Iran and Israel continue to drive safe haven demand toward gold and silver simultaneously. Geopolitical risk does not have a predictable timeline. It does not resolve on a quarterly earnings schedule. And in a world where the primary reserve currency is printing at a DXY below 100, while two regional military conflicts press forward, the argument for physical asset allocation does not require a chart to make. Here is a number I want to leave with you before we close this out. On February 11, 2026, a single trading day, COMEX registered silver inventory dropped by 356,882 ounces in a single adjustment. One day, 3.25 million ounces. Walking out the door in a single session. That is not a data anomaly. That is behavior. That is industrial and institutional buyers deciding that the metal sitting in those vaults belongs in their hands, not on an exchange ledger. When COMEX registered inventory was 240 million ounces in April 2020, and we are now at 81.2 million ounces, a 64.1% drawdown in 6 years. And when 74.38 million of those ounces moved in just the last 60 days, the trajectory of that inventory line is not hard to extrapolate. The silver market in March 2026 is a market at an inflection point. The paper price says 84.37 in consolidation. The physical delivery data says the warehouses are being emptied at a rate with no historical parallel. The Silver Institute says 6th consecutive deficit year. The DXY says the dollar is not the impenetrable fortress it was presenting itself as 12 months ago, and the gold-to-silver ratio, compressed from 105 to 60 in less than 12 months, says the repricing of this metal relative to its monetary counterpart is not finished. The logical projection from here is not a straight line to 309. Let's be clear about that. JP Morgan's base case of $81 average for 2026 implies we may spend significant time below current levels if the macroeconomic environment stabilizes, if solar thrifting accelerates, and if the speculative overlay that powered January's move to $121 stays off the table. That scenario is real. That is a path the market can take. The question is whether the structural physical drain, the relentless daily movement of ounces from registered exchange inventory into industrial and institutional hands, eventually forces a price discovery event that the paper market simply cannot absorb. Watch the COMEX registered inventory line, watch the DXY, watch whether gold holds above $5,000 or whether it corrects sharply. The answer to what silver does next lives inside those three data points, and the relationship between them. Because if COMEX inventory continues draining at this pace, while the dollar continues weakening and gold holds its structural bid, the argument that silver at $84 is a discount to fair value becomes harder and harder for even the most skeptical analysts to argue against. If you found real data in this video, not opinions, not forecasts dressed up as facts, but actual numbers that you can check yourself, then the most useful thing you can do right now is share it with someone who is making a decision about silver without knowing any of this. That is the kind of content that earns a like on this channel. And if you want to be here when the next data set drops, because this story is moving fast in 2026, the subscribe button is right there. No pressure, just logic. And here is the community signal for the people who watch this all the way through. Drop the comment OG John AG 2.0 below. Not because we track engagement metrics, but because in a world full of noise and manufactured urgency, the people who still have the patience to sit with real data and process it to the end are the ones this channel exists for. You know who you are. Make yourself visible. Based on the trajectory of exchange inventory, the structural deficit deepening into a 6th consecutive year, and the DXY sitting below 100 with a Federal Reserve whose independence is publicly being questioned, the logical projection is not that silver runs to the moon tomorrow. The logical projection is that every month the drain continues, the buffer between paper price and physical reality gets thinner. What happens when that buffer disappears is not a question with a guaranteed answer. But it is the question you should be carrying into every conversation about this metal going forward. How long can an $81 million ounce vault satisfy demand that drained 74 million ounces in 60 days? OG John AG. Invest with logic, not with the hype cycle that moves the crowd. The vault is emptying.